Thank you, Oliver. Good afternoon or good morning to everybody. And we can go straight to page 3 of the presentation where we show the numbers for the 9 months. And as you already know, we had a very good quarter and also very good 9 months results. And this applies to all segments and also to all KPIs. As you see, the growth in revenue was 6%, and this is being driven by all segments. The operating profit is 27% higher compared to the level last year. Clearly, last year we had the COVID effects, but even if you adjust for that, the growth rate of the operating profit would be 9%. All segments have also contributed positively to these developments. The combined ratio is 2 percentage points better compared to last year. Here I would say it's more important even to look at the normalization of the combined ratio. We have a combined ratio 93.9. The net cat load is 3.7. If you adjust the 3.7 to the 2 percentage points that we usually are expecting, the combined ratio will be basically slightly north of 92%. So that's also a clear sign that if you adjust the numbers for the net cats, we are very much in line with our 93 combined ratio target, if not even a little bit better of that. On the life side, you see nice operating profit and also a nice new business margin. Then when we look at the asset management, the operating profit for the 9 months is 2.5, with a cost-income ratio well below 60, and also flows of 90 billion, thereof 36 billion are coming from AGI, which is a very good number. 54 billion are coming from PIMCO. So a very good picture for the 9 months. And when you go to page 5, you can see also that in the third quarter standalone we had very good numbers. Here you can see also more momentum on the revenue line for property casualty with a growth rate of 7%. When you look at the operating profit, we have a double-digit growth in operating profit. And when we look at the KPIs by segment, you can see a slight deterioration of the combined ratio, but considering the net cat load of 4.9% is a very good combined ratio. And then in the other lines of business, you can see a very healthy level of new business margin, a very good level in the life side, a very good level of cost-income ratio. In asset management, also positive flows, but I'm going to come back on these numbers later on in the presentation as I go through the segments. At page 7, the solvency ratio is 207, which is stable compared to the level that we had in June or at the beginning of the year. And when you look at the sensitivities, are pretty much unchanged compared to what we had in the prior quarter. At page 9, we are showing, as always, the waterfall, and you can see that the organic capital generation is continuously strong with a 7 percentage point number. When you adjust for the dividend accrual and also for taxes, we have an organic capital generation of 2.5%. The market impact is minus 1%, is relatively minor, and that's coming from a twisting, if you want, of the curve, especially the credit spread curve. Then capital management in total are basically neutralizing themselves, and then we have a negative impact of 5% in tax and other. 2 percentage points of the impact is due to taxes, and then 3 percentage points is due to a sort of miscellaneous or small items that accumulated themselves to this 3 percentage point negative impact. Overall, we have a strong solvency ratio, stable solvency ratio 207, which is in line also with the level that we had in the prior quarters. Now we go to page 11. Coming to the segments, we had a strong growth in P&C of 7.2%. Clearly, Allianz Partners has contributed to this growth with a growth rate of about 50%. But even if we adjust for the numbers for Allianz Partners, we have about 4% of growth. So overall, a good growth rate for the for the segment overall. We see growth in Germany, we see growth in Australia, in Eastern Europe, in Latin America, Turkey, AGCS, Allianz Partners, as I said before, and also in Euler Hermes. We have just a few entities where we are not growing at the moment, and usually the reason can be pressure on the motor side, or in some cases we are doing pruning in commercial lines. The rate environment is stable with and I would say benign, with the growth rates for the renewal of 3.8%. And as you look at the different countries, you can see also that in all countries the development is either stable or positive. So also from that point of view, we are in a good situation. Now, if we move to slide number 13. The operating profit is relatively stable compared to the level of 2020. When we look at the combined ratio, you can see a slight increase of 20 basis points. Here we need to consider that we had more than 4 percentage point of deviation compared to the prior period because of the net cats. On the other side, last year we had about 50 basis points of negative impact because of COVID. And then this year we have about 2.4 percentage point of better run. So when you anyway normalize the numbers for these effects, we still have an improvement compared to the prior period of about 1 percentage point. Most of this improvement is coming from also lower weather-related losses, but there is also a little bit of an underlying improvement. But again, when you normalize these numbers, and you get very easily to a combined ratio which is well south of 93, so also for the quarter, again a confirmation that we are well on track for the 93 combined ratio on an underlying basis. When we move to page 15 on the picture by OE, we see that clearly a few subsidiaries have been impacted by the net cats. Germany clearly with a 14 percentage point impact, mainly because of the floods, but there were also some storms impacting Germany. So overall 97.9 combined ratio, which is a very healthy combined ratio considering the impact from the net cats. Also very good combined ratio in England, France, Australia, Eastern Europe. Italy, we have a combined ratio which is a little bit higher compared to what we are used to, but also the net cats impact was higher compared to what we usually expect to see in Italy. And then AGCS has a combined ratio of over 100%, but considering the net cat impact of 16.3, this is a very healthy combined ratio, so we are very confident that AGCS is going to get to the 98 combined ratio by the end of the year. And then we have a very good performance in Euler Hermes. So when you put together overall a 94.7 combined ratio, again considering the level of net cat of the third quarter, I would say these are very good results, proving a very strong underlying performance. At page 17. On the investment income, we see a decrease of 6%, but this decrease is mainly due to swings in the net harvesting and other, which is basically swing in the FX effects. Otherwise, when you look at the development of the current yield, or is stable. When you look at the insurance, the similar income is even a little bit higher compared to what we had last year. So summarizing for the segment, I would say very strong quarter. Yes, we had the impact of the natural catastrophe, but the underlying performance continued to be pretty strong. Now we come to life. On the life side, I'm very pleased about the development of the new business. First of all, you see a growth rate of the present value new business premium of about 50%. Here we have also the impacts because of the of a contract, of a reinsurance contract that we assume the insurance contract that we had done, but even adjusting for that, the growth rate would be about 30%. And now we can see basically growth across the board. Germany is down, but just for the quarter. When you look at Germany on a 9-month basis, in reality we are growing also in Germany. Then you look at the business mix, is definitely developing the right way. Even if you adjust the numbers for the transaction, for the assumed reinsurance transaction, you will see that the mix is definitely going the right direction. Now moving to page 21 on the operating profit development. We see an increase of about 12%, and this is explained by the increase in loading and fees, in investment margin, and also in technical margin. So I would say all profit sources have contributed to this increase. Clearly, you see also high expenses, but that's also the consequence, clearly, of higher production. So in total, 1.3, if you round it, operating profit, which is well above the 1.1 billion expectation that we have for the usually for a quarter. I would also say that we are at a point where we believe that our run rate is a little bit higher than the 1.1 that we have usually communicated. And with that, when we go then at page 23 on the value of new business, is clearly very healthy with an increase compared to prior period of 80%. Part of it is also explained by this contract on the reinsurance side, but even if you adjust the numbers for that contract, you see a 45% increase in value new business. And I would say that basically almost all countries have contributed to this development, and also in the new business margin you see a very strong picture across the board, and the same applies in general to the operating profit. So overall strong performance in the life segment, and also a widespread strong performance. Moving to page 25 on the investment margin, you see a growth rate of 13%, and that's clearly the combination of two drivers. On the one side, we are increasing the policy reserve, so there is a growth rate of 4%, and on the other side, we are also improving the investment margin. The investment margin is better compared to what we had last year. This is an increase by about 8%. I'm referring here to the margin expressed in percentual term. And clearly, when you combine the two effects, you get to a growth rate of which is double digit. One thing which is also important, we are growing the reserve basis, but when you look at the Solvency II evolution, there is basically no increase in ACR because of the growth on the life side. So from that point of view, I would say there is really a capital efficiency which is coming into play. So we have more reserves, no more capital, and when you look at the FRS numbers, you see an improvement in the investment margin. Also here you see that the current yield is much higher compared to last year, and that's because last year the dividends were pretty low, where now we see a normalization of the dividend payment. And on the other side, you also see that we are continuously reducing the guarantee. So that's a very nice effect, because clearly this development is going to give stability to this ratio as we move forward. Now, coming to asset management, we have now more than 2.5 trillion of assets under management. And when you look at the growth of our assets under management compared to the beginning of 2020, you see a 7% growth rate. If you look at the growth compared to September last year, you see a 12% increase in assets under management. And part of this increase is due clearly to the market development, but in these 12 months we have been able to record 120 billion of inflow. So that's also a very important number to remember. So this increase is not just due to market, but also to a very strong generation of inflows, which was also pretty consistent quarter over quarter. Now if we move to page 29, for speaking specifically about Q3, we see a flows of 26 billion. Thereof, about 20 billion is coming from PIMCO, and then we have about 7 billion coming from AGI. When you see the split by asset classes or by regions, you can see that basically there was a contribution coming from almost all asset classes and coming from all regions. And then also when you look at the split between mutual fund and separate account, you see that the flows are coming from mutual fund, which is also where we have a higher fee margin. And now coming to page 31, you can see clearly that the revenue are up compared to last year by 16% when you adjust for FX, and both the PIMCO and the GI are growing nicely. And on the fee margin, you see also an increase of the fee margin of about 1 basis point. This is coming from PIMCO, and that's also the effect of basically having a higher mix in a mutual fund compared to the separate account. So overall, a good revenue growth for the segment, and also when we look at the segment, a stronger fee margin level. This means when you go to page 33 that our operating profit is clearly growing. This is the effect of the growth in revenue and also of the operational leverage that you have in asset management. So overall, we had a growth rate of 30%. And when you look at the single entities, you see that PIMCO grew the operating profit by about 20%, and I would say very noteworthy is the development at AGI with a growth rate of 72%. Also, the cost-income ratio is clearly going in the right direction, especially at AGI. You see a reduction of the cost-income ratio by more than 10 percentage points. When you look at the 9 months number for AGI, you see a cost-income ratio of about 61%, also with an improvement of 10 percentage points compared to last year. So overall, very strong performance in asset management at PIMCO, but also I would say an exceptional performance at AGI. So we are very happy with this development. Page 35, on the corporate segment, there is not much to say. It's basically a little bit better compared to last year and in line with our expectation. Now I come to page 37. Here you can see that the non-operating items are about 300 million lower compared to last year. This has to do with the amount of realized gains, which has been lower compared to what we had last year. When you put all together, we have a 2.1 billion of net income, which is 2% above the prior period level. So also a good number considering the development of the operating profit and that we had less realized gains below the line. So summarizing, a very good quarter and also very good 9 months with growth in revenue, growth in operating profit. Again, even if you adjust for COVID last year, the growth rate in operating profit was almost double digit. A good increase, very healthy increase in net income. Our solvency ratio is stable and much above our target. We have paid between dividend buyback 4.7 billion of remittances to our shareholder. And as you know, considering the strong underlying performance, we have also revised the outlook from upper half of the range to the higher end of the range. So I would say that based on where we are right now, we are very confident about our operating performance in the fourth quarter. And with that, I would like to take your question.
Yeah, thank you, Giulio. Perhaps before we start with the Q&A session, let me just quickly remind you how you can raise your hand in the new setup. So again, if you join us via web call, please click on the talk request button at the upper right-hand side of your screen. And if you join us via telephone, just press *5. And we will take our first question from Andrew Ritchie. Andrew, go ahead.
Oh, hi there. Good afternoon. Giulio, I wonder if you could just give us an update on what you're seeing in terms of frequency and severity trends in your key non-life markets, I guess in the context of activity returning to normal and also in the context of any sort of inflationary trends. The second question was, at the media call this morning, you suggested in answer to a journalist that I think you could take a reserve related to the structured alpha situation before the year end. I was surprised you were willing to say that. So maybe could you just give us some colour why you felt the need to say that? Is there anything you can say in terms of timing where there's a bit more clarity? Thanks.
Yeah, no, thank you, Andrew. So starting from the first question on the frequency and severity, I would say regarding frequency, we basically see a normalization of frequency that's almost across the board. There might be a couple of countries where frequency might be slightly lower the level that we had pre-COVID, but in general, we see frequency pretty much normalizing at the pre-COVID level. In the case of severity, I would say it's, or if your question is about inflation, I would say we don't see a widespread increase in inflation, so that's not the case. So and then clearly it's always a different situation, country by country or line of business by line of business. I would say on motor TPL in general, we don't see increase in inflation, and that's also because as you know, for the time being, there is no real wage inflation kicking in. So from a motor liability point of view, we don't see that. As you know, we don't have meaningful exposure to workers' compensation, but also for workers' comp, that would be the same line of thinking. As long as you don't see wage inflation, you're not going to see necessarily an increase in severity. When we look at other lines of business, which could be also motor on damage or maybe property, in some cases you can see a little bit of an increase in inflation, but again, I wouldn't say it is widespread. So if you ask me, do we see any impact in our numbers as we speak? No. Do I expect to see any impact in the fourth quarter numbers? Not really. Clearly, we are monitoring this development very carefully. So I would say we are very proactive in monitoring, and then we are going to be also extremely reactive, let's put it this way, if we see that inflation is really picking up. And to this point, the way we are thinking is clearly you can always do tariff increases to offset inflation, but we're also thinking what we can do on the claims management, because that's also an area where we can try to offset some of the inflation that we might eventually see. So bottom line, no, not widespread, but in some regions, in some countries or lines of business, definitely we see a little bit of a pickup in inflation, but for the time being, it's not having any impact on our numbers. So I think we are overall well positioned that we see what is coming our way. On the other question, which was booking before year-end, no, I didn't say that. So first of all, we are going to do a booking when we had the information to do a booking. I cannot envision that we are going to be capable to do a booking before year-end, but you never know. What I said is I believe that we are going to do potentially a booking for the fourth quarter when we close the numbers. But that's also something that I cannot tell you that this is going to happen. So all what I can say is that clearly we are giving high priority to the resolution of this case, and also we would like to put the uncertainty behind us as quick as possible. On the other side, clearly we want to be very, very cautious because we want to get to the best, to a good outcome from an economic point of view. So if you ask me, I cannot tell you when we are going to do a booking. I don't see us doing a booking before year ends, but definitely for the year end closing, we need to think very, very hard about, what if we can put a number, what kind of number we can put there. I hope this clarifies the topic.
Okay, thank you.
Welcome.
Okay, then we take the next question from Peter Elliott. Peter, go ahead.
Thank you very much. And first of all, congrats on the great results. I had three questions, please. The first one, probably predictably on the AGI cost-income ratio. Just wondering if you can help us understand, how sustainable that might be. I mean, you seem to be pointing us to the 9-month figure just now, Giulio, rather than Q3. So maybe that's part of the answer. But even for the 9 months, if I compare the divisions to your outlook, asset management is the one that's performing by far the best. And I know you said that, the outlook was probably most conservative for that division at the part of the year, but I'm just wondering how much of it surprised you, or, whether it's all in line with, what you expected after the actions you took. Any thoughts there would be great. The second one was, I was just wondering how the whole structured alpha fund issue affects your thinking on your ability to do share buybacks or other flexibility, M&A or whatever you might use money for. I mean, even though you haven't disclosed any scenarios for the financial implications yet, I mean, I guess you've got some idea at the back of your mind. And I'm just wondering, do you sort of think of the position net of those, or do you think you can gradually allow for them over time? I'm wondering whether the solvency ratio might become more of a binding constraint. Just how you're thinking about that would be very helpful. And then thirdly, I just want to ask about cyber insurance actually, because obviously prices have rocketed up recently, and it's being attributed to increased frequency and severity of losses there. I mean, I know we covered it in an Inside Allianz series a while back, but I was just wondering if you could update us on your sort of assessment of the risk there, just given that it's a very young and volatile business. Thoughts there would be great. Thank you very much.
No, thank you, Peter. And starting from the first question, AGI, yes, the reason why I pointed out the 61.3 was just to set the right expectation. So I wouldn't say that 57.3 should be the cost-income ratio that we should expect moving forward for AGI. I believe that AGI can operate at the 61 cost-income ratio, clearly, because that's where we are already. Now, in reality, I don't know whether this is going to be the real target that we are going to have for AGI, because to a certain degree you want always to allow also for the possibility to do additional investments. So I would say that 62 to 63 could be a cost-income ratio target that we have for AGI, and this would anyway mean that we have the ability to operate lower than that. So that's the important thing. So it's like for PIMCO, right? PIMCO, we have basically an idea that we like to run PIMCO at not about 60, so slightly below 60. We know that if you really want to just go in savings mode, we can run 55 maybe, so 56. So that would be a little bit the philosophy that we're going to run also with AGI. So I believe we're going to fix a 62 to 63 cost-income ratio target, knowing that this gives us either the possibility to invest in good times or some protection in the case we go through periods where revenue could be lower, because as you know, asset management can be also a little bit volatile. What I can say, we are in a good spot. So that's really a good spot to be. We made a step change, if you ask me. I would definitely say that's been a step change in the cost-income ratio of AGI. You can see also the flows are really, really good, 35 billion of flows. That's something that AGI never had before. I can tell you also October, we had positive flows of 2 billion for AGI. So I believe this company is now performing at a different level. So from that point of view, I think we are starting from a position of strength. That's on the AGI question. On the structured alpha, whether this is changing our thinking regarding capital deployment, I would tell you not really. I don't see that we have a constraint on the Solvency II ratio for the kind of investments or deployment or buyback that we want to do. So at the end of the day, clearly one can put some number around Solvency II and adjust our Solvency II ratio down. I think you can do the exercise the way you like to do. I believe you're going to come still to a Solvency II number which is well above our 180% level. And I will tell you, just since you were asking buyback, let's say a billion buyback is a couple of percentage points of our Solvency II ratio. So I don't feel that there is any constraint, when we think about a billion buyback, 1.5 billion buyback. I don't see that. If we start talking of capital deployment of 5-6 billion, that's a different story. But as long as we are speaking of the normal, steady capital deployment, I would say there is no constraint at all. So we feel we have all the flexibility that we need to have in order to pursue the course of action that we had before Structured Alpha, and also stay tuned because we might also do back book transaction in the course of the next 6-12 months, and that can also somehow provide additional Solvency II ratio. But even in the absence of that, I'm very confident we have all the flexibility and the Solvency II strength that we need to continue with our strategy like before Structured Alpha came into our life. And the last question on cyber insurance, I tell you, we are very cautious. I personally very cautious, and I know that price is going up, but I don't know who is going to win between price, frequency, severity, all these kind of effect that you need to consider. So we are extremely cautious. So we do some cyber, but in very limited amounts, and this means that we have very low capacity per risk, and also we have a pretty strong reinsurance program around it. So which means we are not really going strong in this market at all. So from that point of view, if you ask me, do I see cyber to be an engine of growth and profitability for Allianz in the next 2-3 years? The answer is no. This also means anyway there shouldn't be an area of risk because we are taking a very cautious positioning on cyber.
Great, Giulio, thank you very much. Very clear.
Welcome.
All right, thanks, Giulio. And we will take our next question from Michael Huttner. Michael, please go ahead.
Fantastic. Thank you so much. And yeah, well done for these results. And so my first question, and I really apologize because it's going on the same topic. How much of your time is spent thinking, whether at the board level or personally, or when you have dinner with your family on Structured Alpha? Because clearly it's the only topic which I believe investors are thinking about at the moment. So I just wondered how big the disconnect is. And then the other more kind of boring questions, 93% used to mention that as a target for the combined ratio for the year. I haven't heard it at this call, but maybe I missed it. You were talking about underlying, which may not be quite the same, but it may be, I don't know. You said something about life buyback deals or backbook transactions. Just wondered if you could give a little bit more of an update. And then the final question is on Italy. I was really surprised. I know it's not cats and stuff, but I've been so used to seeing 88 or 86 or whatever combined ratio. I just wondered, are these days over? Thank you.
No, thank you. So starting from Structured Alpha, no, I don't talk to my wife about Structured Alpha. She would divorce me. She's a saint, but not to the extent to have a dinner when we talk about Structured Alpha. But otherwise, clearly, that's something where, as a board of management, we are spending time. But reality is we spend a lot of time also on underlying performance, and as you all see, the underlying performance is very good. And I like to highlight also again the underlying performance specifically of AGI is very good. So we let this at we let at this for Structured Alpha. Now coming to your question regarding the combined ratio. I think your question was how we look at the combined ratio in the 93 and how we look at the combined ratio normalized. So I just tell you, so as of now, I would say that if we just take a normal course of action, our combined ratio by year end is going to be above 93. And if you were to ask my number, I would say there should be about 93.5 based on a normal level on net cats in the fourth quarter. And we have also an aggregate which is going to kick in. So that would be my expectation. Can we go to 93 if we really want to? Yes, that would be possible because we have clearly the balance sheet strength to get there. But I believe it makes more sense to focus on the underlying. And so I would say it's going to be very clear that if we close the 2021 with a combined ratio of about 93.5, with a net cat load of about 3 percentage points, you are going to see that the runoff is very, very normal. I think everybody is going to have a very good pitch about the fact that we are at the 93. In the Capital Market Day, we are going to anyway talk about a target for the combined ratio moving forward, and also consider that overall we are having very good results in asset management and also in life. So I think we are very happy with our operating performance, and so I don't see the need to push the combined ratio. And as you can appreciate, the combined ratio is definitely at a very good underlying level. So that's on that topic. On Italy, because you were asking, I believe, about the combined ratio of Italy. But first of all, usually in Italy we would expect a couple of percentage points of net cat. Now we had about 4. So if you normalize for that, you are 89. And then I would say there is some pressure in Italy on the motor side. The competition is pretty tough there. So, and we are also a little bit cautious, most likely, as we think also about reserve inflation, the pickup in severity that we might see in the future. So, from that point of view, there is a little bit of that too. But also, I just tell you, and I think we talked about that already in the past. We should not expect Italy always to perform at 83 or 85 combined ratio. So we need also to understand that the combined ratio of Italy is still going to be very, very good and very healthy, but it's not going to be the 83 that we have seen for a few years in the past. But that's always been part of our line of thinking. So from that point of view, there is no news here. On the back book, we are continuously looking at where it makes sense to do some transaction. You saw that we did a transaction in Switzerland just a few weeks ago. We are potentially close to do a very small transaction in France, and we are looking at other opportunities always there. In the case of France and Italy, we are not necessarily just doing back book transaction in the sense of doing reinsurance contract, but we're also looking at reworking some of the contracts or to do transfer from legacy products to new products. And also we are looking at opportunity, I would say, in other countries about how we can clearly optimize our capital situation on the life side. Keep in mind that our ROE in life is about 12 percentage points. So we have fundamentally a healthy business, so that's something to keep in mind. But clearly, as we see opportunity to make ROE enhancing transaction, we are going to do so. And to give you an idea, in Switzerland we had over the last years an ROE of 10%, which is not a bad ROE, by the way, for Switzerland. Very stable market, 10%. Now, based on the transaction that we have completed, once we are going to get the capital upstreaming, which is going to happen in 2022, then by 2023 we expect the ROE in Switzerland to be 13%. So that's, I think, a good example of how we can lift the ROE from 10 to 13% through a transaction. And I would say that if you have a 13% ROE in a Swiss operation, I believe it's a very stable Swiss operation. I think that's a very good number.
Brilliant. That's very helpful. Thank you.
Welcome.
All right, then we take our next question from Fulin Liang. Fulin, go ahead. We will open your line now.
Hi, good afternoon. Thank you very much. Three quick questions. The first one is, you upgraded your normalized capital generation again from 10 to 12 percentage point, and then your quarterly capital generation is like 2.5 or 3 percentage points in the last 2 quarters, despite very heavy nat cats. Can I take this like 2.5, 3 as a new norm, quarterly cap gen? So that's the first question. And then secondly is your unit earners. If I remember correctly, you kind of guided that we should expect to see a higher operating profit after the government scheme finished. But if I look at the operating profit from Q2 versus Q3, they're very similar. So am I missing anything there? And then the last question is, I just wanted to understand what is your liquidity capacity or limit in terms of if you agreed on some kind of settlement with DOJ? Thank you.
Yes, on the organic capital generation, I would say yes. You could say that the new normal is to have a capital generation of 10 percentage point per annum. Now, there is always one thing to consider. So in reality, there is also a capital strain in P&C. So if we, it makes a difference if you grow 3% in P&C, if you grow 5, 6, 7, 8% in P&C. So from that point of view, I would always say that there is that element that can depend, subject to the growth rate, subtract to this 10%. The good news is on the life side, we don't see basically any increase in ACR in the business evolution, because even if we are growing pretty strongly on the life side, the new products are very efficient, and then we had the release of ACR coming from the in-force. So from that point of view, I think that's a very good news, that we are not basically increasing our ACR for life. And then on the P&C side, it depends on the growth rate. You might have more business evolution or not. So for example, if you see in this quarter, the business evolution is 0.2. This is coming from P&C. I believe last quarter the business evolution was about 0. So but fundamentally, yes, if you ask me to give you a rough indication of our Solvency II organic generation, I would point out to a 10 percentage point. The other question was Euler Hermes. I would say, first of all, technically speaking, you have a slight increase in operating profit in Euler Hermes in third quarter versus Q2. Now, the point is also that in Q2 we had a substantial release of runoff, and this quarter we have also some release of runoff in Euler Hermes, but to a lower degree compared to what we had in Q2. But if you look at the number of third quarter of Euler Hermes is 130 million. If you annualize that number, we are speaking of 520 million, and before COVID, Euler Hermes was running at about 450 million of operating profit. So that looks pretty good indeed. And the last question, can you please?
Liquidity capacity.
The liquidity capacity. Okay, we have ample liquidity. So really, you should never be concerned about our liquidity position, because we have plenty of liquidity. I would say following. First of all, we have liquidity, let's put it this way, we think from a corporate holding point of view, but you need also to consider that our holding is also an insurance company at the same time. So from that point of view, we have also access to liquidity from the insurance portfolio. But we don't even take into account for that. We just first run with a healthy level of liquidity at the corporate holding level, but we can always access other liquidity sources if needed. So liquidity, we have ample amount of liquidity.
Thank you.
All right, Fulin.
Welcome.
Okay.
Thank you.
Good. Then we will take the next question from Will Hardcastle. Will, you are next.
Afternoon, everyone. Hope you're well. Two questions from me. The first one on solvency. Is there any possibility you can help us to understand the 5 percentage point move in tax and other? I'm sure it's a lot of small moving parts, but any color there might be helpful. And the second component is just on AGI. I guess one risk is that consultants may look to, I don't know whether the word is downgrade opinion or recommend clients to switch away from AGI at some point. That's always been the tail risk, I guess. Have you experienced any of this year to date? Any color there would be helpful. Thanks.
Yeah, no, thank you. So starting from Solvency II, when you look at the 5 percentage point of impact on Solvency II, 2 percentage point, about 2 is coming from just tax, so then you need to reallocate to the operating earnings or market impact, which in this case has been 0. So the rest is basically about 3%. And so when I look at the split of the 3%, I can tell you that about 200 million. So let's talk about the 500 million, right? 0.5, the 500 million. 200 million is basically coming from the tax offset. So we have less tax offsets compared to what we had before. Now, just to give you an idea, the tax offset is over 5 billion. So now that you have 5.2 billion of tax offset or 5.4 billion of tax offset, that's really, coming from when you run the model and what kind of, which companies are going to contribute in the given scenario to our ACR. So that's really noise, but these are already explained basically about 1 percentage point or the 3 percentage point you were referring to. Then we have also some minor updates, assumption updates. Then we have an exposure update that can be also about 50 basis points. And the point is when you calculate the Solvency II ACR, you need to make basically a projection about what you expect your premium exposure to be next year. So if you are planning with premium growth, this is going to lead to a higher ACR right away. So that's what we put in other. When we do the business evolution, we put under the business evolution the effective increase in premium. But when you run a Solvency II model, you need already to consider for the expected premium increase. So that will be about 50 basis points. The diversification is a little bit less. Then you get other 50 basis points. And then if you want, I can bother you with some other very technical stuff. But we are speaking of very minor amounts, and they all accumulate in the same direction. But for example, the exposure update, that's a very simple to understand. This means that we are anticipating that next year we are going to have a higher level of premium compared to what we currently have.
Yeah.
This helps?
It does indeed.
Yes, and but I can always organize a one-on-one with our risk guys. In reality, it's more logical than you think. So logical, yeah, it's pretty logical. And then clearly, it's we have 42 billion, 43 billion of ACR, so you just need small movement here and there, and this is really just a small noise. On AGI, on your question about the consultants. Yes, there could potentially be a risk. We didn't see this yet. As I was saying before, we had 2 billion of inflows at AGI in October, and we had also positive inflows in September. Please keep in mind that in reality, the AGI institutional business in the US is not really crucial, let's put it this way, for AGI, and also keep in mind that Structured Alpha is really a specific strategy. So from that point of view, I cannot exclude that we might see some consultants suggesting to the clients to go somewhere else, but it's not something that we saw. Structured Alpha was a very specific strategy, and in any case, the institutional business in AGI is not by far not really the primary source of revenue for AGI.
All right. Then we will take our next question from Will Hawkins. Will, we will open your line now.
Oh, hello. Sorry, can you hear me?
Yes, we can. All good.
Hey, thanks, Julie. You've already said useful stuff about the ability to do buybacks, which I think was mostly focusing on the kind of flow that you're generating each year. Just with regards to capital management on the balance sheet, absent some of the big volatility that we know could be around the corner, what's your intended direction of travel for this Solvency II ratio? Because the difficulty for me is, the only figure you've put out there as a target is 180%, and you're massively above that. And so I don't know if we should always be considering a massive cushion, or if you should be running your balance sheet more efficiently. So given that you're around 210% at the moment, structurally, is the intention to keep it at that level, to get the ratio back down to a more efficient level, or maybe even to be building the cushion up? I mean, when you used to have a ceiling, I think it was 220% or something, but I know you've dropped the ceiling. That's question one, please. Question two, forgive me if I missed it and tell me if I do, and I'll go back and read the transcript, but when you were talking in detail about back book transactions, I don't think you referred to the US, which clearly is the market that's most in focus at the moment. Can you just remind us, you've always been really committed to your US portfolio and proud of it. What is the size and nature of the kind of business that you may be looking to exit from in US life? And then lastly, just very briefly, you've done another RT1 debt issue. You've already been very clear about your confidence on liquidity, but what's the overall direction of travel for debt leverage from here? Are you at a level that you want to maintain? Could you be issuing more debt or bringing it down again? Thank you.
Thank you, William. So on maybe starting from the last one, or from a amount of leverage that we have right now, from amount of hybrid, I would say we are planning to be stable. Then clearly over time, the idea is to increase the level of hybrid based on the increase in the size of the business. But as we go into, let's say, next year, the idea would be to keep the amount of hybrid flat, which means since the business is going to grow automatically, that would also mean in reality a lower leverage ratio. So from that point of view, you should expect stability on the amount and a leverage ratio which is slightly decreasing, and then we usually wait a couple of years and then we do again a bump in the hybrid in order to keep a certain level. So that's the way we are thinking about our hybrid issuance and our leverage ratio. But as you think about the next 12 months, so you can expect that we are not going to be particularly active on increasing the amount of hybrid. On your question about the USA, as fundamentally, and as you said, the business has high quality. We might be looking at reinsurance also of fixed index annuity and also VA, so both. They can be, depends then clearly on what kind of offer we get. We can go down both routes, but we are also believing that there is a possibility to monetize value on the fixed index annuity side. So that's definitely an area where we are taking a look if we can do anything there. So that's something that we might have also some news in the not far future. And then the other question was on capital efficiency. Sure, if you talk to a CFO is always going to be for capital efficiency. So the idea clearly is not to run with a solvency ratio, which is, look, if you ask me, I'm really not in the camp of let's advertise a solvency ratio to 20 to 30. I don't think this is healthy. So I'm not in the competition to have the highest solvency ratio of the industry. That's not the way I think about solvency. I believe capital is something that you need to have enough capital to be sustainable, to be resilient, but you want also to have the least amount of capital in order to be as efficient as you can. So from that point of view, as we are working to also reduce the volatility of the ratio, we can bring this our target level down, or the excess that we keep over the target level down. That's something that I would definitely say will be a success, and that's also something that we are working on, and some of the back book transaction might help in that direction. Not necessarily any transaction in the US will not necessarily help from a volatility point of view, but transaction in Europe, they can bring down the volatility, and then they can also help us to bring down the target level, to bring down the excess that we keep on top of the target level.
Thanks, Giulio. Would you be able at all to help size your US back book under review? I think it's been quoted saying tens of billions, but that's obviously a pretty wide range.
No, I don't tell you right now. Once we have news, I will give you all details, but as of now, you think anyway it's the US, right? So the US, you don't speak about 5 billion, you speak about more, but at this point in time, I don't want to go too much into further details. Sorry for that.
Thank you very much.
Okay, welcome.
All right. Then we will take the next question from Dom O'Mahony. Dom, go ahead, please.
Hi, folks. Thank you for taking questions. A couple from me. One, just turning back to the asset management business, and I guess this is a broader point about performance. You might have thought from the outside that the reduction in bond yields, notwithstanding the recent increase, might make fixed income a bit more challenging to play in as an active manager, given that the fees consume more of the yield. That hasn't seemed to happen to you. You have very strong mutual fund flows in fixed income. Is that the sort of pressure that you're seeing across the industry that you're just avoiding through very good performance of your funds, or are there other factors to think about in terms of why we should think that both flows and revenue margins there should be sustainable at this level? And then the second question, I hate to ask a question about structured alpha, and I understand there's nothing you can say about the specifics, but I wonder if you could help us understand what the prerequisites would be for setting a provision. Are there any technical things that need to happen for you to be able to set a provision, maybe requirements from an accounting perspective? Thank you.
Yeah, starting from the first question about our performance in asset management. Yeah, it's a function of performance, clearly. So when you look at the performance of Pinko, but also the GI, by the way, it's definitely a very good performance, and this is definitely helping to sustain very healthy flows. And you can think also, especially when rates are very low, it's very critical to have somebody that can produce some extra yield is even more relevant. So from that point of view, that's definitely the component number one. But then I would not underestimate also the distribution reach. AGI is a very strong distribution, especially in Europe, and also in the US, the distribution strength of Pinko is pretty strong. They have also invested in quality distribution. So it's a combination of performance, and that's the primary driver. But then I will not underplay also the distribution aspect. But that's also the reason why, as I was saying before, we are not necessarily looking to run these companies at the lowest possible cost-income ratio, because you want to invest also in distribution, you want to invest in technology. So that's part of the equation, that you cannot aspire to have very strong and positive flows, but then you're going to be basically keeping these companies under investing. So when you put all together, anyway, you can see a very, very strong picture. On the litigation side, on the structured alpha side, at the end of the day, what you need is to have more clarity, and time in order to get to a better understanding of what a possible range might be. That's all what we need.
Thank you.
Welcome.
All right, we will take the next question from Vinit Malhotra. Vinit, the line is open for you now.
Thank you, Oliver. Thanks, Giulio, for taking my question. Just so one question, just back to the AGI. I mean, it's remarkable we're talking about AGI. It's had 40-odd billion flows since supposedly this event took place. But I mean, going forward, do you think that when you said 60 to 63, 62 to 63 kind of cost-income ratio, does that consider the risks of greater compliance costs or other regulatory potential burdens? And I'm just curious whether this thought is somewhat in the number, or should we think about that going forward? Second thing is on the life side. I'm just zooming in on the capital efficient products, which obviously the headlines are very appealing, 300, 350 range. For a while used to be 200 plus 225 sort of range of operating profit. But I also note that pre-DAC, the number isn't that high in the capital efficient product segment. And now it's 2 quarters in a row that pre-DAC was far lower than the headlines. How should we be thinking broadly about capital efficient products, and whether we are now at the cusp of this 330, 350 kind of quarterly run rate, or should I be reading more into this pre-DAC numbers and then thinking that we've had a few lucky quarters in capital efficient products? Thank you.
Okay, so the first question was about CGI and whether I think that the 62, 63 cost income ratio could be much different if we have to step up our compliance resource. I don't think so. In the sense also, I don't believe that we have any particular compliance issue or control issue at the GI. So from that point, I can see that maybe here and there we need to strengthen a few things, but I don't believe this is going to be a primary driver for the cost income ratio of the GI moving forward. So I would say that a 63 cost income ratio should be achievable even if we need to step up our compliance effort.
Yeah, perhaps, Vinit, if I may just add one comment here. I think it would be rather the opposite, because one big driver for this cost-income ratio reduction is complexity reduction on the product side, among other things, and with less complexity, it should be much easier to keep things under control.
Okay.
So then coming to the question about the SIAC. No, first of all, I don't think we had just a few lucky quarters. So I would say that we should see a good development of our production, also our operating profit in SIAC. One thing to keep in mind is there is a special effect in the way we are calculating operating profit in Germany, because basically you need to do we do a DECO set for GAAP. And when you do the DECO set for GAAP, we apply basically 90% policyholder on the DECO set. But in reality, when you look at the statutory accounting, you have a 50% policyholder offset on the acquisition cost. So you get basically, technically speaking, a sort of acquisition cost drag. And since that's the area where Allianz Leben is growing, then you get this acquisition cost drag into the numbers of SIA. So from that point of view, as this business, let's put it this way, is maturing, you're going to see in reality higher growth of even higher growth of the profit in SIA. But I would say the direction is pretty clear. So from that point of view, you're going to see how the contribution of this business is going to grow also in terms of operating profit over time.
Okay, thank you.
Michael.
Okay, I have one last caller here on my screen in the queue. So, Michael, welcome back. The floor is yours.
Thank you very much. It's a big privilege. So, 2 questions. One a really, really cheeky one, and you might say, I can't answer that. And the other one, another. So, on the cheeky one, there was a lovely dinner yesterday organized by one of your peers, AXA. Clearly, or I could interpret that investment they made in bringing all their guys together in London as saying they're the new Allianz. Is that a potential concern for you that, as a result of all these things, the rating might sustainably be lower, which would kind of reduce the pool of deals you can do and all sorts of other stuff? I don't know, the broader consequences. I'm basically asking it for this the structured offer. And then the kind of geeky question is, so you're now into the aggregate for NatCat. NatCats have been high this year. Is this something where you think, I want to buy more reinsurance, or reinsurance is so expensive, I want to buy less? How does it look like?
Okay, so I understood the geek question. I didn't understand the first one. Can you repeat the first one?
The cheeky one, yeah.
Relative to, so AXA is effectively my interpretation, saying we're the new Allianz, we're the new guys, who are going to deliver and look at us, we're shiny, we're new, everything's going well for us, which basically means that, the rating can improve and they can then consider deals which are more expensive and relative, you might lag a little bit. And therefore, that would reduce the opportunities you might see in terms of deals. You would, your cost of capital goes up, so your pool of deals reduces a little bit. Is that a kind of broader concern, considering structured alpha, I suppose?
Okay, got it. No, I never talk about peers, so I don't have any comment to make, and I wish everybody well. And on the other question, the geek question, so reinsurance, I would say the following: we have been looking at our reinsurance structure because clearly we know also that there will be an increase in premium, in insurance premium coming our way. So we have looked at different reinsurance structures. But at the end of the day, we achieved the conclusion our program is pretty good, so we are comfortable with the program. We might do some tweaking to the aggregate level, so that's more about the attachment point, the capacity, but fundamentally we are not changing our insurance structure. And from a pricing point of view, I would say we are generally a very good account. So from that point of view, yes, we expect to see some increases, but in our case, since we are a good account, the increases should be more moderate. And anyway, these are also increases that clearly we are going to put into our calculation for our premium. So from that point of view, the answer to your question is we have analyzed different options, but eventually it's going to be pretty much business as usual with respect to our reinsurance program, just with some tweaking. And right now we are going, by the way, through the negotiation. So let's see what comes out of the negotiation.
Fantastic. Thank you very much. Thank you.
You're welcome.
All right, I just got another caller. I don't see a name here, so whoever you are, we will open your line now. Go ahead, please.
Hi, again. I just had
Vinit, hi. Yeah.
Sorry. Sorry. I just had two questions on P&C which I didn't ask that time. One is on the pricing trend. I mean, I was a bit surprised to see AGCS report a lower 3Q pricing. I think it was about 9% versus 15% at 1H. I mean, is it driven by some of the fronting business noise? Because otherwise in the market, everybody is talking about some reduction, but not such a reduction. So any comments on that, please? And second thing is just on the P&C ordinary investment income. The private equity continues to be a strong component, or at least supporting component. Is there any better view now whether this is sort of half sustainable, or how should we think about that? Thank you.
So starting from AGCS, yes, okay. The growth rate of AGCS was also partially because of fronting. If you adjust for it anyway, we had a high single-digit growth rate. This is also consistent, by the way, with the change in renewal that you see. Your point about people seeing some reduction in pricing strength, that's to a certain degree true. So if you see our number is 15% for the change in renewal. That number was, I believe, slightly above 20 last year. So there is a little bit of decrease, but it's still a very healthy environment, and you need to think that these rate increases are accumulating, right? So they accumulate compared to what we got at the end of 2019, what we got throughout the course of 2020, and then you have also clearly the rate increases we are getting as we speak. So there is a decrease in rate increases, but still very healthy rate increases, and think about the accumulation effect. This is definitely very healthy for the for the combined ratio. Otherwise, with respect to the investment income, what we are seeing right now compared to last year is more dividend coming also from private equity funds that we have. So this is definitely helping the interest and similar income. As we move forward into 2022-23, we still expect to see some pressure because of the low interest rate environment, but clearly this pressure is diminishing over time because part of the portfolio has already been turned into the lower interest rate environment. So from that point of view, I wouldn't say that we have a bottom right now. So we're still going to see potentially some pressure, but not to the same degree that we saw over the last 3-4 years. So if you remember a few years ago, our investment income was 3 billion. Now we are closer to 2.5. We are not going to lose 500 million of investment income in the next 3 years. So we might be a little bit lower than the 2.5, but not significantly lower than that. So I would say that the worst is behind us.
Great. Thank you very much.
Welcome.
All right. So we have no callers left in the queue. Therefore, this concludes today's conference call. Thank you very much for joining this call. We say goodbye to everybody and wish you a very pleasant remaining afternoon.
Thank you, guys. Have a good rest of the day.
Bye-bye.